Definition of accounting, nature, and functions. Accounting, often referred to as the language of business, plays a critical role in providing essential financial information that drives decision making for individuals, business, and other economic entities. Technical definitions of accounting have been published by different accounting bodies. The American Institute of Certified Public Accountants, or ICPA, defines accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character, and interpreting the result thereof. Accounting Standards Council, or ASC, states that accounting is a service activity. Its function is to provide quantitative information, primarily financial in nature, about economic entities that is intended to be useful in making economic decisions, in making reasoned choices among alternative courses of action. According to American Accounting Association, or AAA, accounting refers to the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. Reagan, Kiezo, and Kimmel defined accounting as an information system that identifies, records, and communicates the economic events of an organization to interested users. Bierman and Drebin stated that accounting may be defined as identifying, measuring, recording, and communicating of financial information. This author, Professor Maria Teresa Mapue, defines accounting as the systematic process of analyzing, recording, classifying, and summarizing data contained in financial transaction source documents, or FTSDs, or records to produce financial statements or reports that provide information about the performance and financial condition of an economic entity to serve the needs of interested users. Accounting is the systematic process by which financial data is transformed into meaningful information. It involves a series of steps that turn raw data often found in financial transaction source documents, or FTSDs, such as invoices, receipts, and bank statements, into organized financial reports. These reports provide information regarding the financial performance and condition of an economic entity, serving the needs of a variety of users, from business owners and investors to creditors and government agencies. The process begins with analyzing transaction from source documents. Each transaction is carefully examined to ensure its nature, whether it is a sale, purchase, or payment, and how it will affect the financial records of the business. Once analyzed, the transaction is then recorded in the company's books, initially through journal entries. Every transaction is captured to ensure that no financial activity goes unaccounted for. Next, transactions are classified into various categories such as revenues, expenses, assets, and liabilities. This step is crucial because it organizes the data, making it easier to interpret and report. Proper classification ensures that similar transactions are grouped together, which is essential for accurate financial reporting. The classification of transactions is through posting to the ledgers, where all similar transactions are transferred from the journal. Once classified, and at the end of the period, the data are then summarized to prepare financial statements. Data are summarized with the preparation of the unadjusted trial balance, where all the totals or balances of the classified accounts in the ledger are listed. From this summary, some accounts are updated to determine the net income of the business, which is reported in the income statement, and the financial health or status, which is reported in the balance sheet. Preparation of the cash flow statement does not use this summary. Instead, the ledger is used to determine the movement of cash during the period or the comparative financial statements of the business from which increases and decreases are analyzed to determine the effects on cash. The cash flow statement tracks the movement of cash in and out of the business, showing how well the company manages its liquidity. The purpose of this entire process is to provide information about the company's performance and financial condition. This information is crucial for decision making, as it allows business owners and managers to evaluate how well the business is performing and where improvements may be needed. Investors and shareholders use the financial reports to assess the profitability and financial stability of the business, while creditors and lenders look to these reports to determine whether the company is creditworthy. Additionally, government agencies rely on accurate financial statements for regulatory and tax collection. In essence, accounting transforms raw financial data into structured reports that help various stakeholders make informed decisions. It is a critical tool that ensures financial transparency and accountability, enabling businesses to track their financial activities, evaluate their performance, and plan for the future. The nature of accounting. Accounting is a dynamic and complex field that can be viewed from multiple perspectives. As an art, it involves judgment and creativity. As a science, it follows systematic methods. As an ideology, it reflects broader societal values. As a language, it communicates financial information. As a historical record, it preserves the economic past. As a commodity, it provides marketable services. As an economic reality, it captures the financial essence of business transactions. And as information system, it organizes and delivers critical data. Understanding these various dimensions highlights the vital role accounting plays in both business operations and the broader economic landscape. Accounting as an art. Accounting is often described as an art because it requires skill, creativity, and judgment to apply established principles and concepts. Just as an artist uses tools and techniques to create a work of art, accountants use various accounting standards, rules, and guidelines to present financial data in a way that provides meaningful insights. The preparation of financial statements, analysis of financial information, and communication of results involve subjective decisions that reflect the accountant's expertise. While accounting follows a systematic approach, it also involves human interpretation and decision making, particularly when dealing with complex transactions. Accounting as a science. At the same time, accounting is considered a science because it is based on a body of knowledge that is systematically developed and follows logical principles. Like science, accounting involves a process of observation, experimentation, and analysis. It uses universally accepted standards such as generally accepted accounting principles or international financial reporting standards to measure and report financial transactions. Accounting principles are tested and validated over time, ensuring consistency and reliability in financial reporting. Thus, while there is a creative aspect to accounting, it also relies on structured methodologies and established procedures that are grounded in evidence and objectivity. Accounting as an ideology. Accounting can be seen as an ideology because it shapes how people think about and understand financial reality. It reflects the values, norms, and assumptions of a particular economic system, especially capitalism. Through accounting, concepts such as profit, loss, and equity become part of the language and practice of business. In this way, accounting reinforces specific ideas about how businesses should be managed and how success should be measured. The way in which accounting standards and practices are applied can influence behaviors and decision making within organizations, aligning with broader societal and economic goals. Accounting as a language. Accounting is often referred to as the language of business because it communicates the financial health and performance of an organization. Just like any language, accounting has its own rules, syntax, and structure that must be understood to effectively convey meaning. Financial statements, for example, tells a story about the company's economic activities and position, but the language of accounting, debit, credit, asset, liabilities, revenue, expenses, must be interpreted correctly to gain insights. This is why accounting is essential for stakeholders such as investors, creditors, and management who rely on this information to make informed decisions. Accounting as a historical record. Accounting serves as a historical record of a company's financial activities over time. It tracks past transactions, revenues, expenses, and financial performance, allowing businesses to see how their financial position has changed. The records created through accounting provide a timeline of financial events, offering insights into the history of the business. These records are crucial for legal, regulatory, and tax purposes and help businesses and stakeholders understand how the company has performed and what decisions led to its current financial state. Accounting as a commodity. In modern economies, accounting has become a commodity. It is something that can be bought and sold, especially in the form of accounting services provided by professionals. Auditing, financial consulting, bookkeeping, and tax preparation are all examples of accounting as a service industry. Many organizations outsource their accounting functions to external firms, which treat accounting as a specialized and marketable product. The expertise of accountants and the tools they use, software systems, and frameworks are valuable commodities in the financial world. Accounting as an economic reality. Accounting reflects economic reality because it represents the financial transactions and economic activities of an entity in a measurable way. While accounting uses numbers to depict financial performance, it goes beyond mere numerical data. It translates economic events like sales, purchases, and investments into quantifiable figures. The purpose of accounting is to provide a true and fair view of the company's financial position, which helps to convey the actual economic reality behind the numbers. However, this can sometimes be subjective depending on how transactions are recorded and interpreted according to the various accounting standards. Accounting as an information system. Lastly, accounting functions as an information system. It collects, processes, stores, and communicates financial data to users who need it for decision making. Just like any other information system, accounting systems organize data so that it can be retrieved and used efficiently. Through accounting systems, data from financial transactions are entered, processed into reports, and then communicated to relevant stakeholders. These systems ensure that information is reliable, timely, and useful for a wide range of users, from internal management to external investors and regulatory bodies. Accounting plays a critical role in the operation and success of any business or organization. Its primary functions ensure that financial information is accurately captured, organized, and presented in a way that facilitates decision making, compliance, and strategic planning. One of the fundamental tasks of accounting is recording transactions. Every business transaction, whether it's a sale, purchase, payment, or receipt, is systematically logged to create a reliable financial record. This meticulous recording process forms the foundation of all subsequent accounting activities. Once transactions are recorded, they are then classified into appropriate categories such as assets, liabilities, revenues, and expenses. This classification is essential for organizing financial data, making it easier to analyze and generate reports later. After transactions have been classified, accounting moves on to summarizing financial data. This is typically done through the preparation of financial statements like the income statement, balance sheet, and cash flow statement. These summaries provide a snapshot of the organization's financial health, offering insights into its profitability, liquidity, and overall performance. Beyond summarizing, accountants must also analyze and interpret financial information. By looking at key metrics, trends, and ratios, they provide deeper insights into how well a company is performing. These analysis helps management and other stakeholders understand whether the business is meeting its financial goals, where improvements can be made, and what strategies need adjustment. The next important function is reporting financial information to stakeholders, whether it's a detailed annual report for investors, a quarterly update for the board, or a monthly performance review for internal use. Accounting ensures that decision makers have access to accurate and timely financial data. Transparent and well prepared reports not only inform stakeholders but also build trust. Accounting also plays a key role in budgeting and forecasting. By using historical financial data, accountants can help organizations to plan for the future, creating budgets that guide spending, resource allocation, and investment decisions. This function is critical for long term financial planning and sustainability, helping organizations to prepare for both expected and unexpected financial situations. In addition to planning and reporting, accounting ensures that businesses comply with laws and regulations. Financial records must adhere to accounting standards such as GAAP or IFRS, and taxes must be calculated and filed accurately to meet legal requirements. Failing to comply with these regulations can result in legal trouble or financial penalties. So, this function of accounting helps protect the business from such risks. Another vital function of accounting is ensuring internal control and fraud prevention. Accountants establish systems and policies that safeguard a company's assets and ensure financial transactions are legitimate. By implementing controls such as segregation of duties and conducting regular audits, they reduce the risk of errors or fraud, further ensuring the integrity of financial records. Accounting also plays an integral role in supporting management decisions by providing financial insights and analysis. Accountants help leaders evaluate potential business decisions such as launching new products, entering new markets, or controlling costs. Tools like break even analysis and cost benefit analysis assist managers in making informed data driven choices. Additionally, accountants are responsible for managing taxation. This includes calculating taxes, preparing tax returns, and ensuring compliance with tax laws. Effective tax management helps businesses avoid penalties, reduce liabilities, and make the most of available tax benefits. Lastly, auditing and assurance functions ensure that financial statements are accurate and compliant with relevant standards. Internal audits assess a company's internal processes, while external audits conducted by independent auditors provide assurance to investors and regulatory authorities that financial reports are fair and accurate. Together, these functions of accounting form a comprehensive system for managing and reporting financial information. They support the business in maintaining compliance, making strategic decisions, controlling costs, and ensuring long term financial health. Through accurate records, thorough analysis, and effective reporting, accounting provides the foundation for informed decision making and organizational success.